All right, what is good, y'all? This one is going to be a bit different of a style video. I am going to be on the charts, pretty much going over unprobable conditions and what I look for when not to take a trade. So this is what I'm looking for. Hold up, let me point to the right side. This is what I look for. This is what I look for. And this is what makes trades not high probable. I got a request to make a video on this, so I will go over it. Pretty much simply going over what I look for and what tells me when a trade, when I don't have high conviction for a trade, this is typically why. So let me get into it. So first off, draw on liquidity. Draw on liquidity is the most important thing. I've said this before, if you do not have a strong draw on liquidity, you are simply taking a jump shot blindfolded. You are hitting a golf ball with your eyes closed. It is the dumbest thing in the world to target a draw where you don't have the utmost conviction. It's really dumb. So let me just go over strong draws on liquidity. Strong draws on liquidity. So every single morning, what I do going into the day is I hop on the 4-hour time frame. I hop on the 4-hour and I'm like, all right, what are strong draws for the day, right? So we can just see on the 4-hour. So for the next coming days, let's say we end up making a move lower. Let's say this coming week. All right, I'll hop on the 4-hour time frame. What are some strong draws, right? We have boom, boom. We have all these draws on the hourly. Boom, boom, boom. All of these lows. These are all very strong draws in liquidity, right? High time frame, high time frame, high time frame. And I also know that session lows exist as well. I also use session lows. So the main draws in liquidity I look for are previous day high, previous day low, maybe even a previous week high, previous week low, all-time highs, hourly lows like this. But typically it will stem from the higher time frame, and it is most importantly to just make sense, right? Like how I look at it is, all right, does it make sense for price? Like, okay, so I ask myself this: do we need to take out this high or a low to make the next move in the market, right? So ask yourself that, right? Looking at this sequence here, as you guys know, the NASDAQ and the S&P is overall a bullish market. Like we are typically bullish. So in order to make a move higher on higher time frames, on the weekly, on the daily, what do we need to do, right? We probably need to go out and take these lows at some point, which we will. I guarantee we will. So that's just one thing I ask myself. Does it make sense for the market to go out and take this draw on liquidity in order to make a move in the markets? And if the answer is yes, then it is probably a strong draw on liquidity. And this goes for lower time frames as well. Today was a perfect example, right? We had these session highs here, Asia high, London high, and I asked myself, all right, so let's say I'm bearish on the day. I ask myself, does it make sense for these draws in liquidity to get taken if we want to make a move lower on the day to go out and take London lows? Yes, it does. And obviously they didn't get taken, but ES took them. So if you were looking to long ES, you could ask yourself, all right, in order to make a move lower, we probably are going to go seek out these session highs, Asia high and London high, right? So just kind of ask yourself that, and that is the number one important thing. If you're not trading to a draw on liquidity, I mean, draw on liquidity is everything. If you don't have a strong draw, it's not a high probable trade. So that's the first thing. Number two is we're not ranging. What is a range, you might ask? Let me find a good example. Okay, a good example right here, right? So I trade a continuation. I do not trade a reversal. I do not trade support and resistance. I trade a continuation. So again, if you're like trading support and resistance, you probably absolutely eat off a range bound day. But as a continuation trader, right, you are looking to catch a continuation in the trend. It is in the name, continuation. And when we are in a range like this, we are not continuing anywhere, right? We are moving up and down, up and down, up and down, and we are not continuing, which automatically makes it less probable. So you're asking, how can I recognize and how can I see that we're in a range? So let's say, right, this is New York market open right here. Here, I'm gonna go to replay mode. Let's say New York market open is right here, and as you can see, right, we're in this range. So what I do if I see going into the day we are in a range, this is on the 15-minute time frame. So what I do to avoid these range bound days is I simply will not scale down to the lower time frames. I will not scale down to the 1 minute. I will stay on the 5-minute time frame and above until we break out of this range, right? So let's say New York Open is here. I am not scaling down lower than the 5-minute time frame unless we make a move like this, unless we make a move like this and break out of the range, or we make a move lower and break out of the range. It is so simple, because when we are in a range like this, what do? We edge highs and we edge lows. Like, as you see, we're not continuing anywhere. We're just bouncing, bouncing, bouncing. So as a continuation trader, you are most likely going to get stopped out or get break even on that trade. So the simple way to avoid this is generally do not drop down to the lower time frames until we have broken out of the range. So what I do is I stay on the 5 and 15 until we break out. Very simple. So the first two things, draw on liquidity and not ranging. The third thing is volume. Volume is very important, right? So I will use yesterday as an example. I will use yesterday as an example, right? So okay, so I'm going to use yesterday and today, right? So as you can see, we have, well, as you know, we have FOMC later this afternoon in like an hour and a half at 2. We have FOMC, so that typically means the market is not going to make huge expansion moves before that. So yesterday was a perfect example, right? You guys see, this is the 5-minute time frame. We do not have volume in the markets. And when we do not, like, and it's an obvious tell, right? Wick, 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 small candle, small candle, small candle, small candle. This is immediately a less probable trading day. Why? Because you want to trade with volume. The number one thing and the number one tip I have for continuation traders is you can make it so easy on yourself by simply telling yourself, okay, I will not take a trade unless we are moving with volume and displacing in one direction. You just made it 10 times easier on yourself. You just made it 10 times easier by eliminating trading in a range and low volume, because you are simply waiting for price to be moving in one direction to a draw on liquidity with volume. So if you see, we are making really small candles. We are throwing a lot of wicks. That could be a sign for you to just maybe get off the charts. It is less probable, and these are not highly probable conditions that I want to be trading, right? So when you see low volume like this and we are not moving cleanly in one direction, that is a low probability condition that will most likely lead to your trade possibly getting stopped out for that reason. Number 3, size of gaps. Size of gaps is very important, right? So let me find an example. Let me just go to the 15 here. Please give me an example. What the hell is the market doing? Alright, perfect. Right here. Okay. So, right, you see this. Okay, this is not the best example, but maybe it looks better on the 5-minute. Actually, let me go to higher time frames. Let me find a higher time frame. Okay. Perfect. Okay, so you see this big 4-hour gap, right? You see this very large 4-hour gap, and this goes for every single time frame. It goes for every single time frame. When you see a large gap, it is most likely going to hold. So this is just one example, right? But again, I just want to say this: the larger the gap, the higher probability it is going to hold, and the trade will play out. Again, I'm trying to find a better example for you guys. But so, like, as a continuation, you are trading typically a retracement into a gap, right? So with that being said, why would you start looking for gaps that are just like really small? Like I like to say, if you really have to look at it and be like, oh, I need to mark out this gap, it is not a high probable area that price is going to hold, right? You are banking on prices retracing to an area in price that is going to hold, and then you're going to catch the flip out of it. So typically, it is much better the bigger of the gap. The bigger of the gap, the more likely it is to hold. So with that being said, just like if you ever catch yourself trying to like squint and try to find a gap that, oh, we need to retrace off this area, it's not probable. So the bigger the gap, the better the probabilities. The next thing I have is size of the retracement to the flip sequence. So, right, let me find an example. This is very important. I need to find a, here, this might take me 1 minute. 1 minute. Asia. Okay, I can use this as an example. It's not the absolute best example, but it will do. Okay. So you see how... Hold up. Okay. So you see... Alright, sorry y'all, my fucking trading view just cut out. But I was talking about the size of the retracement to flip sequence. As a continuation trader, you're looking for a move like this, right? Trending price action, like I said, trending in one volume, you get a retracement, and then you get a flip. And the flip, which is this, right, is very, very important because I trade a very discretional way. I trade very, very, very discretional. And being able to judge why an entry is good or bad is mainly based off just generally judging the flip and looking at the exact candle. So, right, when you are looking for a flip like this, you are looking for it to be clean with no hesitation. And let's say we are doing, so I'll just bring up two case scenarios, right? We're trending both same case scenario, we're trending to a high, we're trending to a draw on liquidity. This one, it takes 6 candles. It takes 6 different candles to finally get through this retracement, right? So you can see this, right? Relatively cleanly, we have a strong draw on liquidity here. And you see how there's zero hesitation. Boom. Okay, so it looks better on the 5-minute here. But you see, like, this was literally today's trade. You see how there is zero hesitation and it takes 1 candle. 1 candle to... Oops. It takes 1 candle to work through this gap, right? There's no hesitation. There's no, like, just fucking... What's the word? There is no... whatever. But you see how clean this is, right? You see how these things look alike. Boom, retracement, flip, and then doom. That is what you look for. And the second you start seeing hesitation like this, is the second that the trade immediately goes to low probability. So I'm going to try to find a bit of a better example, but today we actually had a pretty good example, right? Like you can see here, this is clean, clean. We get a retracement and then boom, flip, boom, flip. Compared to if we get this retracement and it took 1, 2, 3 candles to finally get through this gap, it probably would have been a trade that got stopped out, right? And you can see here as well, this is later in the day before FOMC. What do we not have? We are ranging. We have low volume. We have no really gaps. So let's see if I can find an example here. Okay, I'm gonna show you another good example. Okay, so you see this sequence right here, how it takes 1 candle or 2 candles to absolutely flip out of this retrace. This is what you look for, right? This is the shit you look for when looking for a high probability setup for a continuation. No hesitation, clean looking candles, big candles, and the sequence after the retrace is stronger and more confirming. That is the main thing you look for. You want to look for, because you're simply just looking for a continuation that we're going to continue in the same direction. So what is the biggest thing when looking for that? A confirmation that we are going to continue going in that direction. And what you get from is displacing candles, and those displacing candles should be stronger than the retrace sequence. Like I said in this previous one, right? If we're going like this, and then you get this. It takes forever to get through it. That is a low probability trade, and there's a high chance the next candle is like this, and you get stopped out, right? Compared to this, retracement, boom. No hesitation, strong flip, displacement, strong candles. That is the shit you look for. So that goes over size of a retracement to flip sequence right there. And then what else do I got? Again, no hesitation. Like you shouldn't, like price should not hesitate, right? Like you see, okay, so let's say you're looking for longs here and you want to see price go like this. And you want longs, but no, we start hesitating, and it gets stopped out, right? So hesitation when going in one direction automatically makes it less probable. Clear candles making big moves, right? Again, the moves should be popping out of the screen to you. They're like, the moves should not be where you have to squint and be like, oh, is this a clean trade? No, it should be extremely clear, and you really shouldn't even have to think twice about it. Again, I've said this before, I think, but on an A+ trade, you really don't have to think twice about it, right? Like on this trade here, I didn't take this today for multiple reasons, because I didn't really get the perfect entry. But again, like when you see this sequence right here, this short off the 5-minute, you don't really have to think twice about it. It kind of, you see it and you're like, wow, that is clean. And this is what I'm talking about when I'm saying clear candles creating big moves. You see how it's no hesitation in the sequence. We're going bang, boom, boom. And you can see they're big candles creating gaps, and this makes it so much more clear and obvious when we're making moves in the market. Like you can see these candles, small candles, not creating gaps, and then boom, you have a much better sense of direction where the market wants to go when these gaps and candles are very clear, very big, engulfing, displacing candles. So if you simply just wait until price actually clears up and you start seeing candles like this, start seeing candles like this, that's when it makes it much more obvious. And one more thing is RR. If you are trying to force a trade, I call this draw on liquidity FOMO. I feel like I made a TikTok on this, but it is called draw on liquidity FOMO. It's where we have an obvious draw on liquidity, very obvious draw on liquidity, and you all of a sudden ditch your entry model because you want to get an entry to this draw, right? In this case scenario, London lows. We are displacing very heavily towards the low, and you can take a very good assumption that we are going to take the low. I would agree with you, but does that mean you can fully ditch and just take a trade even if it's not your entry model? No. Again, so like if the RR is absolutely cooked and you're forcing a trade and scalping a trade right next to the draw on liquidity, it is never worth it. I've gotten fried on this way too many times, and I promise you it is not worth it. Forcing a trade right next to the draw on liquidity will always result in not a good scene. I mean, it could play out like this. Obviously could play out, and you get what, your 0.5 RR. But you're forcing a trade right close to the draw on liquidity. It is never worth it. This is also called bottom blasting, just like trading without a retracement. So please, guys, just wait for a retracement in price and wait for your actual confirmed entry model. In this case scenario, if you would have waited, you probably would have got it, right? So please stop forcing trades extremely close to the draw on liquidity just because you're getting FOMO that you're going to miss the move. It's never worth it. So to conclude this video, the main takeaways are: 1, you should be trading to only strong draws in liquidity. Only strong draws. Number 2, we should not be ranging. When we are in a range, what can you do to stay out of those conditions? Stay on higher time frames, 5 and 15 until we break out. 3, volume. Wait till the candles are clear and are big, like this. Like this. We are actually moving. Wait until there's volume in the markets. This is a low volume. You see we are going nowhere, right? Big difference. 3, the size of gaps. The bigger the gap, the higher the probability of the trade. And right, if you're waiting for a retracement into the gap, it's obviously going to be a much more high probable trade because that gap is most likely going to hold. Number 4, the size of the retrace to flip sequence. The flip out of the retrace should be a stronger and more confirming and overall more convincing candle sequence than the retrace. Number 5, no hesitation. There should not be any chop when price is flipping. It should be clear. It should be clean. No hesitation. Number 6, clear candles creating big moves, right? Again, an example today, very clear, no hesitation. We are boom, retracement, flip, clear candles, big candles. You can obviously see the move. It is an obvious move. And the last thing, RR, do not try to force a trade extremely close to the draw because you are simply think you're going to miss the move. I promise, bro, it is never worth it. So with that being said, those are some things that will be un-probable conditions when you're trading, some things you can look out for, and just things you want to simply avoid. And if you avoid all these things, your chances of winning your trade immediately just boosted. Like I said in the beginning of the video, if you simply wait till we are moving in one direction with volume, the candles are clear, your win rate just boosted by 80%, bro. If you simply just wait until price clears up, moving in one direction to a draw, your win rate just skyrocketed. So with that being said, that is the video. And again, in the description, all my socials, TikTok, Instagram, free Discord. I teach in my free Discord literally every single day. And then I am affiliated with Alpha Futures. If you want accounts with Alpha, code Jack gives you a discount. And last but not least, subscribe, you goats. I'm posting these every day. So if you want to be caught up, hit the subscribe button, and I'll see you guys in the next one.